Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
What's doing well, on the other hand, is Taiwan. That index is up almost 0.6%.
Working along that same line, we're going to have access into India.
25,001 should not be broken. 25,200 on the Nifty bank is up about 0.25%.
There has been a soft commitment from LIC to put in bids for as high as a little over 5,000 crore rupees.
Mid caps are flat, but there's some positive bias to that.
Our revenues are very stable over the last few years because we are a large group. We have large number of television channels.
As far as retail is concerned, the stake is reduced to 28.7% from 38.7%.
51% stake is what Dixon will be acquiring in QTech.
The headline index, as Vic mentioned, all four of them are the major indices. They are in the green currently.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel D'Souza. And at the day's high, in the morning, things looked a little shaky. Yeah. We were never under the risk of a collapse. So things never got, weak or ugly. But just look at that intraday chart. From the day's low, it's been a recovery more than 100 points. And now back above that 25,200 mark.
Well, I'll tell you, Reema, the PCR at 0.7 and FI net shorts at 1.2 lakh contracts has normally been a winning theme. We have seen that in the past as well. So the markets may not bounce very much from here, but there's always that scope to see bounces, because the shorts are in the system. So as you get the bounce, this call writers run for cover, the shorts as well run for cover. And if you look at it, Reema, the bounce has been good on the Nifty. The few factors that are played out is your tech companies, they've not delivered great numbers. But those dips are getting bought into. So the tech index, in fact, is rallying today. We have Tech Mahindra that will be delivering its numbers, 0.8%. That's doing the heavy lifting today. Pull up the Nifty bank. That's been in fine form. It's protected the 20 as well as the 50 DMA. That continues to do well. So good move is what we're seeing on the Nifty bank. In a bit, we'll pull up the Nifty as well as the 20 DMA. But the third part of the Nifty that I'm going to pull up is the Reliance Industries stock. That one has recovered close to around 0.5% from the low point of the day. And most of that has come in the last 20 to 30 minutes. And because of that, we've seen a good bounce. You have all the participants of the Nifty, that's the IT index, the Nifty bank, as well as Reliance Industries. Just 1 point, the Nifty 50 needs to get past the 20 DMA. Beautiful. Just take a look at that. That's the one that we're looking at. Around 40 points away from these levels. If you can get past that, then you're bracing for a further bounce from here on. But that buy on dip has worked out perfectly well, Reema, today. And overnight, you had the Nasdaq actually that did a relative outperformance.
Record high on the Nasdaq.
Record high out there. NVIDIA, leading the way out there. And today, the tech index has done quite well. So I think it's a very good looking screen going by the uncertainty you're seeing on the globe.
Okay, so how should you position yourself in the last hour of trade? What would be the stock calls you should be taking? Mitesh is now joining in. Mitesh, would you take comfort from that intraday recovery? Or do you think we have some more ground to cover before you turn constructive?
Well, good afternoon. I think, what is the most comforting part is the Nifty PSU banking index, which is given a breakout. Last time we saw a high of around 7,230 and then 7,250. And today we saw a high of around 7,300 plus, and we are just trading about 7,270. So I think the PSU banking index, which is stocks like State Bank of India, Canara Bank, Bank of Baroda, they are doing well. And that's why I think the Nifty is not turning weak. My sense is that I think the Nifty, could even suggest that this bounce back could extend to about 25, 300, 320, 330 zones. But only once we start getting past those levels would have turned aggressively bullish. Till then, I think it's more of stock-specific trade, though, on the long side. I do have a buy on Canara Bank. I was just discussing that stock. That's a buy with a stop at about 115 or 114.75. And a target of 122 can be looked at. And the other one is Bajaj Housing Finance, which I would recommend buying with a stop just below levels of 120 for a target of 129.
Okay, got that. Any IT stock on your radar? They've bounced back, despite the bad news in the last couple of days. First, it was many of these ER&D companies like a Tata Elxsi, a Tata Tech. But now even Wipro is higher in trade ahead of numbers tomorrow. Tech Mahindra reports numbers today post-market hours, and that's showing you a gain of about 2%. Infy's up 1.5% ahead of numbers next week. So market seems to be believing bad numbers may come, but at least, the negative reaction could be in the price.
In fact, yes, I think a lot of these IT stocks didn't come out with any kind of, the ones which have announced their results. Nothing encouraging over there, but I think, the price action is slightly on the positive side. With that, a disclaimer that I have long positions in Tata Technologies, looking at a target of around 760, 780 to begin with, then maybe even higher. But that apart, what is also looking very interesting is Tata LXI. I think, that's the stock which had a big breakout in the last 2-3 days. Today is giving a pullback. So this could give you a good entry point. If you get the stock close at about 62.50, 62.40 zones, buy there with the stop below 61.80. And I think the stock could top 6,600 levels.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, let's get to discussing a couple of stocks then. HDB Financial, that's in focus, post its Q1 numbers. Gaurav is here to help us out with more details on that. Gaurav, the stock is coming for some profit taking.
Well, yes, when we talk about the numbers for HDB Financial specifically, we have seen some kind of weakness, and there are two reasons behind it. First is that the disbursement has gone down almost by 8% on a year-on-year basis. And second disappointment came from the credit cost. Now that has inched up almost by 10 basis points. And as a result, when we talk about profitability, we have seen a dip of around 2.5%. So first, let's understand the numbers. Net interest income has gone up almost by 18%. We have seen NIMS expansion of around 10 basis points, which was actually positive. When we talk about pre-provisional operating profit, there also we saw a good growth. In fact, the cost to income ratio for the stock and the company has actually come down, which is again a positive thing. But credit cost has inched up, and as per company's overall commentary, they have highlighted that the CV, which is commercial vehicle segment, is something which is going to be a pain point for the company, at least for this quarter. And that is the reason why the cost to income and specifically the credit cost has increased. When we look at the commentary going ahead, they believe that in second quarter, there will be some stability, and going ahead from second quarter onwards, there will be credit cost which will stabilize and come down. And that is the reason why they believe that ROAs can go up. Let's not forget that for Q1, ROAs has come down to 1.9%, but it also includes the fundraise. So if we exclude that part, ROAs have been at around 2%, which is again a little lower than the street's expectation. But management commentary suggests that ROAs can go up. But at least for now, in this quarter, because of the weak numbers, specifically increase in credit cost, we are seeing a negative reaction in the stock price.
Okay. All right. Got that. Thanks a lot for that, Gaurav. And the other stock actually that's in focus in today's trading session is actually Shriram Transport. Shriram Finance, I think we should get that stock as well up for you. From the word go, the stock has been under pressure. That's because I was reading a couple of notes as well. In Macquarie states, they're expecting some kind of trouble in the CV space because HDB, in their commentary, they said that they did see stress in the vehicle finance, particularly in the CV book. And the CV book is largely for small truck owners and not large fleet. So because of the comments that came out from HDB Financial on the CV space and the kind of stress that they're seeing out there, Shriram Finance is a little bit under pressure. Let's pull up Chola as well, because that as well was mentioned in the Macquarie note that I read earlier this morning. That as well could be a little bit tepid. No, that's holding up in the green. But Shriram Finance is the one that from the word go has been down close to 3%, and it continues to remain under some pressure. Prakash, what's your view? HDB Financial, from the issue price, it's still much higher. These numbers are a little bit weakish. And if you have any kind of read-through for Shriram Finance.
No, so Nigel, I think HDB is still too fresh, too new for people to kind of take judgmental calls in terms of whether these numbers are good enough for an entry. And of course, the higher issuance price becomes a bias of sorts. But if you take that out and not kind of, if I didn't know the issuance price at 810, 15 watt, is HDB a buy? The answer is you'll still have to give them a couple of quarters to start coming into the reckoning in terms of the competitive environment that top NBFCs today play in. It's no mean feat for a Shriram, for a Chola, for a Bajaj Finance to kind of have clocked these numbers. They all have their own strengths. HDB will also have to kind of start standing for some sort of a USP, some sort of a strength, and that's going to take a couple of quarters. So I'll wait. Shriram, of course, I think is one of the best in breed NBFCs that you have. They've consolidated. The balance sheet has got ever stronger. And my sense is that he'll probably continue to acquire certain portfolios which will help them scale up much more faster than the competition, because organic growth is definitely coming at a cost in terms of time and money. And that's something which most NBFCs are aware of. So anybody who gets to carve out a decent acquisition, a decent portfolio, if not the whole company, they are the ones who will do well. And I think from that perspective, Shriram Finance stands a very good chance. They've proven in the past, in the recent past, that they're up to it, and they could probably continue that strategy. So quite positive, but again, it's a long-term secular comment. It's got nothing to do with the move today. Today, the day has gone to PSU Bank. So, everything else will probably get eclipsed given the way they've outshone most other subsectors in the BFSI space.
HDFC Bank started with strength. As soon as that bonus announcement came through in the morning, it was a positive tick, but now has completely flattened out. So first ever bonus for HDFC Bank, and plus that special interim dividend. Now, the bank has been paying dividends regularly, but this time, what would you expect in terms of a special interim dividend?
So, Rima, I think the money that they've got through the HDB Financial Services float, that's something which makes sense to pass on to shareholders, given the fact that they cannot increase their book till their credit deposit ratio starts getting into that tolerance zone. So, I think they're very consciously going slow on that, making sure that quality is not compromised, but the book grows in a very calibrated way because of the fact that, when interest rates start coming down, there is a rush towards deposits, and HDFC Bank ends up getting that by default. So, it's probably the go-to place, and SBI and HDFC Bank, these are very strong recipients of all the inflows. So I think the bonus announcement probably doesn't make a material difference to the stock in any case, but the dividend could probably be more of returning the money that's come in from the float of the HDB Financial Services IPO. So if you do the math, it'll probably be slightly more than what they've been paying off all these years, and it could be a bit more generous. So that's the advantage. But of course, it has its own tax implications, and hence people will probably see it as a post-tax effect in terms of what comes home. So that's why you didn't see the stock hold on to that momentum that was there when we heard the announcement in the morning.
Okay, all right. Got that. Thanks a lot for that, Prakash. Well, let's hop across to Nimish. RBL Bank, that's on our radar to offer the shareholding pattern for June, reveals that mutual funds have increased their stake in the stock significantly since March 2025. Nimish joins us to tell us more on that front. Nimish?
Thanks, Nigel. So as you rightly pointed out, RBL Bank is in focus. A big update in terms of the shareholding pattern. And mutual funds combined has increased the stake in RBL Bank in just one quarter from almost 15.3% to almost 29%. So nearly 14% is what the mutual funds have added into RBL Bank in just one quarter itself. That's not the case. Even FPI, which is the foreign portfolio investors, even they have increased the stake from 14.4% to 17.6%. So these are the two large holders, mutual funds as well as foreign investors. They have significantly increased the stake in RBL Bank in just one quarter. The insurance holding is pretty much flat at nearly 3%. So who sold out? The one big entity which is sold out is part of the foreign company's portfolio. Their holding has come down from 7.5 to almost 3.5. And within that, British International, they seems to have completely exited out of RBL Bank. This is according to the shareholding pattern as of June. They were only holding close to 3.8% as of March. That doesn't exist in the June filing. So it looks like British International has completely exited, selling the 3.8% in RBL Bank. The other big stakeholder who've reduced the stake dramatically is the retail shareholders. Their holding has gone down by nearly 10% in RBL Bank in the last one quarter itself. Now, coming to the mutual fund, which is the most important part of that piece, which is wherein the mutual funds have added nearly 14.5% stake in just one quarter. In that, the significant stake addition has come from SBI Mutual Fund. In the June filing, SBI Mutual Fund owns now close to 3.3%, which was not there in the March quarter. So that's one big addition within the mutual fund, which is SBI Mutual Fund. Tata Mutual Fund now owns close to 2.1%, which was not there earlier. Same is HDFC Mutual Fund, 1.6%. Aditya Birla Mutual Fund owns nearly 1.3% now. And Mirae and Nippon are the other ones who've added. Nippon, in fact, was owning close to 3.3%. Now they're up to 4.3%. So clearly, among the mutual funds, the biggest investor in RBL in the last one quarter has been SBI Mutual Fund. But the big story is basically at the headline level, the mutual fund holding in RBL Bank has gone up by nearly 14% in just single quarter, from 15% to almost 29% now.
Thank you very much for that. That's doubling, Nimesh. The increase in just one quarter. So MFs have doubled, FPIs have shown interest, so their stake has gone up. But on the other hand, retail investor interest seems to have declined. So Prakash, who's got it right in the case of RBL Bank?
I wish we know of this at this stage. But remember, it's a bank that's been quite sought after by a lot of other suitors as well. We had, apart from the couple of banks from the Middle East that were spoken about in terms of having immense interest, you also had the Mahindras looking at it at some point in time, and they happen to have a significant corporate ownership of this bank. You know, what's happened is the opportunity to buy this bank, which was just kind of at the cusp of repair, came in when in March or April it went almost as low as 160. And that was on the back of a lot of the issues that it faced, starting with the credit card bans and all of that. But the recovery from that has been so significant that you'd probably see most of this buying has happened because you are getting great value. Now, if there's a turnaround in the bank, and if you have a new, management coming in, or a new owner wanting to kind of capitalize the bank and start growing it, it has everything going for itself. So I think that seems like the case. A lot of people, I mean, so many people can't go wrong. And the consensus seemed to be that this will deliver and will become probably a very leading private sector player in the space that's been vacated by Yes Bank, to some extent by IDFC Bank. So there's this vacated space that needs to get filled. RBL probably has that this thing. I mean, just conjecture at this point in time. I have no empirical data to support it, but I'm sure evidence will keep coming as we go along. So from that perspective, definitely makes for a very good risk-reward opportunity.
Okay, all right. I think Nimesh wants to make another point on this.
Yes,
Nimesh?
Nigel. So Rima, one point from my end. So, Rima asks us to who is basically right and wrong. Especially in case of retail investors, I guess it's just a transfer of ownership from individual to mutual funds. Ultimately, mutual fund is also, in a way direct, in a way retail only. So it's good in a sense that it's been concentrated now. Instead of one or two individual investors owning, the mutual funds are owning a big chunk of RBL Bank. And this was part of my chatter yesterday as well. For RBL Bank, the next big trigger is going to be the fundraising. Now remember, they have an enabling provision which gets over, I believe, in August end to raise up to 3,000 crores. So that fundraising is lined up. And as what even Prakash was highlighting too, there were media reports which suggest that one foreign bank, the Middle East bank, is eyeing a big stake in RBL Bank. So whether that will require an RBI approval, but nevertheless, there is a fundraising lined up in RBL Bank. And I think the board meeting is scheduled for results on 19th. So after that, there could be a potential fundraise as well. So that would be the next big trigger as far as RBL is concerned. But from a shareholding point of view, it's very clear that now it's getting concentrated within the mutual funds as well as the FPIs to a larger extent. And most of the retail investors seems to be out of RBL Bank.
Okay, got it. All right, Nimesh, thanks a lot for clarifying on that front. Well, it's only Wednesday, but Prakash, I'm coming across to you. What about a few drinks? Tilak Nagar Industries up more than 10%. Everyone's been talking, I was at a bar over the weekend and they were saying that they're going to be having this band on Monday because the way the duties have gone up. But it seems the street, seems to be thinking that maybe the government will give some kind of a leeway, either increased, licenses or maybe larger number of timings to party. That'll be good, moving the deadline from 1 a.m. to 3 a.m. Let's see how that goes. But, a few days ago, I think on Monday, we had Allied Blenders that ran up. Today, Tilak Nagar Industries, the bulls are drunk on that. Stock up more than 10%. What's your pick from this pack?
So, Nigel, I think essentially what's happening is there's a rotation within the sector. The Maharashtra-focused players are probably something to get out of, and markets are people are looking at allocating more money to, businesses which are agnostic to the Maharashtra decisions. And you have Tilak Nagar, which gets primarily a lot of its business from the south. They are one of the biggest presence in terms of brandy, their distributors, so Old Monk, so Mansion House and all of that. And there's a lot lot of issues that got sorted out in terms of the brand ownership between Allied and them for some time. It's been going on. So with that clarity, you'll see some expansion in both these names in the distribution networks. But these are a bit of a flash in the pan kind of stories. They don't see sustained buying because it's yet to kind of prove itself. It's not like a Radico that moved from 130 to wherever today it is in the last 7 years. You will only find that in some opportunity, which one of them, of course, is United Spirits. But whatever drawbacks and weaknesses and triggers it has had, it's been so resilient. And my sense is that it will probably be, once the once the UK, India FTA starts kind of getting digested and gets into implementation mode, at these levels, it offers great risk reward. But you'll have to be extremely patient. There's nothing which is going to happen like what you're seeing in Tilak Nagar today or Allied last week. But it's going to take a while. But if you're willing to wait, it'll probably be a very robust presence in the portfolio.
Okay, all right. Well, let's focus at the bottom of your screen as well. If you wanted to buy a DLF apartment here in Mumbai, then that's your chance. They're coming out with flats of around 1,200 to 1,500 square feet approximately. And the rough cost, if I saw that correctly, was around 4.5 to around 7 crores or thereabouts. And the cost is going to be 38,000 to around 48,000 rupees per square foot. So DLF will be in focus both from a market perspective and for a client's perspective here in Mumbai. But let's talk about something related to real estate. Cement companies and South-based cement companies, well, they are firing away in today's trading session. What are the factors at play? Well, one is that the street is bracing for an improved performance in the first quarter of FY26, as in the South, we saw very, very sharp price increases. The other hope is maybe there could be some kind of consolidation, just maybe. And that explains why if you pull up this stock of Deccan Cement, the stock is up close to around 20%. So the street is speculating whether or not it's a consolidation candidate, we don't know. But let's focus on the fundamentals because that's what we are best at, right? Deccan Cement's total capacity is around 4 million tons, out of which 2.2 million tons expansion was in the works. The EV very, very roughly, at current reckoning, it's around 2,200 crores. That's putting the debt together with the market capitalization. However, analysts estimate that maybe around 400 crores of capex could yet to be incurred to get to that 4 million tons because they had a capacity of 1.8 million tons and they had 2.2 million tons that was coming on stream. So the total number will come to around 4 million tons and the rough EV will be around 2,600 crores very, very roughly, which means, the company is finding buyers or, for the stock, not for the company, at an EV per ton of around $70 to $75 on a per ton basis. The valuation is attractive in comparison to replacement cost, but for a South-based company, $75 actually is a tall ask. That said, we have a couple of large names that are going to be delivering numbers in the next few days. JK Cement, all of a sudden, they're coming out with their numbers very, very early on a Saturday itself. So we'll keep an eye out on that. Then the big boy Ultratech Cement and Dalmia Bharat. Just in the next 4-5 days, just thought I'll put an alert with regard to the results. But if there is a possible consolidation taking place in South-based companies, then maybe focus on a couple of other names as well that are trading at a very sharp discount in comparison to replacement cost. Case in point being a Sagar Cement. You pull up the chart, you'll see it's been buzzing all through the trading session. NCL Industries, small asset as well over there. That one, in fact, is trading at around $45 to around $50 on a per ton basis. But the one that has an immense value is KCP. I'll tell you why. Because the total EV is at around 2,100 crores. That's netted of the cash of around 500 crores that they have. The cement capacity that they have is around 4.3 million tons and they have adequate limestones for the next many, many years. So in case they want to expand, they have that. They also have a sugar business in which the listed entity holds close to around 67% stake. That's in KCP Vietnam Industries. So we can't do a vanilla EV per ton out here. But if you only value the total EV and take into account the 4.3 million tons capacity, then the asset is at around $60 per ton, which means effectively that you're getting the sugar business free. So that one, in fact, as well is buzzing. You pull up the intraday chart of all these stocks. Deccan has jumped up. We'll have to see what exactly is the reason for that. But it seems, all these names, all through the trading session, there is that speculation that maybe, in fact, there could be further consolidation. We don't know about that. But fundamentally, we thought we'll explain to you what's going on out there. And also, these quarters' results will be very, very good. So let's see how that goes. Prakash, what is your take? Some of these companies, they've had value for very, very long. KCP, Sagar Cement, Deccan Cement, I've heard it many times actually in the last many years. But the street is speculating maybe that's, this time around is going to take place. And in the recent past, whether you look at Orient or you look at the other assets as well, Kesoram, deals that we saw didn't take place in the previous 10 years. Suddenly they've taken place in the last 12 to around 18 months. So what's your view on the South-based companies?
No, I mean, thanks for making it so interesting. In fact, the next week or so, till the numbers start coming through, I think this is going to be a center of attraction of sorts, because it's one pocket that probably is close to the bottoming out of the cycle. Okay, post-monsoon, I don't think cement companies will be talked about in the same breath as what they're being talked about now, because they've been a bit of sideways movers, but things are looking very different from whatever updates that we are getting, whether it's pricing potential, whether it's capacities, cost control, all of that. So I think it's a wonderful space to allocate more capital to if you don't have it yet. The names that you mentioned, we've discussed Sagar sometime back, about a year plus back, and then Deccan just about a month back, and it's also rallied from there. The problem is that consolidation in the south has been a bit tricky because you have very small assets. Unlike assets in the north and the east, where some of the larger acquisitions have really been very, very fruitful. So if you're adding 4.5 tons, it's not empty. It's not something which is very dramatic for anybody. But consolidation is the need of the hour if you want to really build scale and efficiency, right? So the larger players will have to continue fighting each other out in terms of that metric and bring their overall efficiencies higher and the costs lower. From that perspective, they continue to be suitors, but I really don't know whether pricing is conducive at this point in time. Especially Deccan doesn't really have much in terms of your pricing power or distribution or anything beyond this capacity expansion that's happened after so many years. So I would still go with the larger players. I would go with the acquirers rather than the being acquired names. And from that perspective, ACC continues to be Shree Cement, continues to offer tremendous opportunity from where they are in terms of organic growth purely. So I have a slightly different view. It's more cautious, more low on risk reward, but I'm fine with that.
All right, got it. Prakash, what would you make? But if someone is buying this Deccan Cement, and we don't have, it's a very, very grey picture. We don't have the proper details. We don't even know how much more capex they need to incur. We've just taken a ballpark 400 crores. Suppose there's an acquirer at $75 per ton. What would you think? Will they be overpaying? Because there's plenty of capacity in South India. Utilization levels are, very, very low. Pricing has improved, which is good, but still utilization levels very, very low.
No, absolutely. So, if you and you very rightly mentioned KCP, which comes with, a very high support or comfort of raw material supplies. Now, what happens is the moment you look at a KCP, it's always been muddled or a bit of a mixed bag because of the sugar business also coming along. If they were to demerge the two, the cement business could definitely fetch much more value beyond that $60 per ton. So, I'm not sure whether they're willing to pay, they're willing to sell at this level or this point in time. But if that was available, I think it makes for far better economic sense and then hive off the sugar business at some point in time at an opportune moment whenever you get that. So I would believe that Deccan, there could be some other reason why it's probably being, it's seeing that action. But I don't think it's just a pure acquisition play at work at this point in time.
Yeah, and we've heard that in the past as well. Just in the last 1 month, the stock is up 50%. But we are here to explain the fundamentals to our viewers. And Prakash, thanks a lot for analyzing that for us. As you said, you need to be a little bit cautious on the smaller names, whether or not there's a deal or not. But he'll be preferring the larger cap names that are trading at decent valuations. Appreciate you joining in, Prakash. Thanks a lot for that. Well, also, as we slip into that break, remember to tune into our all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m., the Big C, where we focus on currencies, commodities, and cryptos, and the Global Lens at 8:30 p.m. Welcome back. You're tuned into Closing Bell here on CNBC TV18. Well, as promised, let's get chatting with Pramod Gubbi, co-founder of Marcellus Investment Managers, who joins us on the show. Hi, Pramod. Good to speak to you after a while. How are you all feeling about the markets? You know, as of now, things are looking pretty okay. We have inflation that's cooled off, and people are quite excited about that, you know, because it's only around, I think it's the lowest we've seen in the last 6 years or so. However, part of the street is a little bit concerned, because the nominal GDP will not even be 10%. And that's after many, many years. You know, you put together 6.5% growth with 2% inflation or thereabouts. We're falling short out there. What's your take on the markets? Do you believe that in the near term there could be some kind of problems because urban demand is not picking up? Or do you believe the RBI is growth focused? Things are going to recover in the second half of the year. So this is the start of the next leg of the up move.
Yep. Thanks for having me here. Like we've been saying over the last few quarters, I think we're coming off a period of pretty strong growth, driven by government capex and the consumer spending post-COVID. At some stage, both of these drivers had to cool off. I think the government is clearly on the fiscal consolidation path, although the first 2 months of this fiscal public capex has been strong. But I think going by government tax collections, that has only so much upside and perhaps could even cool off going ahead. The consumer piece as well is cyclical. Part of it is cyclical. You had a revenge spending boom. At some stage that had to cool off. In fact, the revenge spending was accentuated by retail borrowing. Most banks were flush with funds. They supported personal loans, microfinance, which accentuated that boom. That had to cool off as well. We are in the middle of that cool down. But there's a small element of a structural issue around job creation and recovery in consumption, given automation and AI is pervading all aspects of life. And company after company we speak to are talking about being skeptical of hiring. That's a big structural issue to be concerned about. Hopefully, we'll figure out other avenues to create jobs. For example, manufacturing is picking up, but that remains a concern. That also means that this slowdown and drop in inflation is expected, right? The inflation has dropped because naturally demand situation is cooled off quite significantly. At the same time, companies or corporates' pricing power is also cooled off significantly. So it's the other side of the demand cool off, which is the lower inflation. That also means that the RBI has a little more leeway in terms of loosening monetary policy, either by pumping in more liquidity, which is done quite a bit already, or cutting rates perhaps in the August round as well. Now, these effects will not by itself translate to demand creation. Maybe at the margin, certain projects become more viable because the cost of funding comes down. Hopefully towards the second half, we can see that come through. But we'll also need some uncertainty driven by the whole trade and tariffs things to go away for corporates to feel comfortable and start spending, both export demand as well as domestic demand. That is anybody's guess as of now. So for now, I reckon the market situation will be driven by a fairly modest demand environment with a lot of hope in terms of monetary policy triggering a recovery. That will also mean that earnings slowdown that we've been through over the last 4 quarters is likely to sustain at least for the next couple of quarters. Which in the midst of where market valuations are, I reckon investors should be prepared for muted returns going forward, unless and until we see either a sharp correction or a recovery in the demand situation.
So how would you play all this, Pramod? The stress in the job market, tech companies are already, sort of flashing warning signs, no wage hikes. Hiring has slowed down. They're only doing specialized hiring. What about tech? If consumption is going to get hurt, because there is that ripple effect, as you spoke about, so till we get, and RBI has also sort of front-loaded the rate cuts. How do you play this in terms of an investment theme now, this muted phase return?
Like I said, for investors, the best approach is through asset allocation. At the end of the day, you have real, tangible financial goals, and you get your asset allocation right in terms of equities, fixed income, gold, and real estate. And within that, you get your allocation to large caps and small caps, quality versus value. And be systematic about rebalancing about this. As far as we are concerned as asset allocators, as asset managers, we're at the end of the day trying to position ourselves to give our clients better returns than what the index would give, which is their opportunity cost, by buying into a low-cost index fund so that we justify our fees. From that perspective, we are less concerned about the absolute returns in the market, right? Given we've got, 24-25% returns from the market in the last 4-5 years, that's unlikely to repeat. In fact, the next 5-year returns will be significantly below average, the long-term average for the Nifty being 12%. I reckon if the market gives 10%, to beat the market, you need to be positioned to give 12-13% on a post-fee basis. There'll always be opportunities from that perspective. So if you're relatively positioned to do better than the market, but at the same time being realistic about absolute returns, I think there are still opportunities in the market. Private banks, for example, is an opportunity where we think that while growth may not be significant, we reckon on a 5-year basis, you might still get 15% earnings growth. But at least valuations are reasonable. I won't say compelling or attractive, but compared to several other pockets of the market, they are not giving you potential downside risk from a derating perspective. So pockets like that do exist if you do manage your expectations in terms of absolute returns.
Pramod, how are you all feeling about the pain space? That's been a big pain point. Pains has been a pain point. But some believe that deal that was long awaited, that's out of the way. It's not a new player that's taken that stake in AkzoNobel. And maybe, India is bound to recover in the second half of the year. All that, the better prices will play out, discounts could hopefully go away, and things will look up. Are you in that camp?
Absolutely. I think the pain in the pain space that you're alluding to happened together because of both reasons coming, which is the macro slowdown in demand. Overall paint demand hasn't been this weak ever in India's history. I'm talking about decorative paints. At the same time, you saw competitive intensity coming up with a large new player coming in. Hopefully, like you mentioned, with the rate cuts playing through, there is a pickup in housing, and therefore paint demand recovers, at least from a statistical base effect perspective at some stage through the next 12 to 18 months, demand should recover. And we've seen the capital cycle play out. From a competitive intensity perspective, we've seen an exit of an existing player. And that capacity is bought in by an existing player as well. So to that extent, we're seeing competitive intensity actually get more benign compared to what we've seen in the last 3 years. So both demand recovering and competitive intensity becoming more stable, I would reckon the next 3 years should look good for paint companies, both in terms of growth and margins.
Thank you, Pramod, for joining in and providing that insight. Time to get into a break. But before that, let's talk about Network 18, because that's rallying post the Q1 numbers. Margins have improved for the company, even as viewership share has risen too in the quarter. It's been a tough quarter. Listen in to what the company's managing director, Rahul Joshi, had to say about the performance in the road ahead.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%. But from last year, it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops. I think that, in this first quarter, we are EBITDA positive. If you look at the next 3 quarters, I'm hoping that, the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs under control in our existing businesses. Costs are mildly likely to go up only in our new investments. maybe in areas like First Post or in money control. So overall, I am hopeful that, the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. July is looking slightly better. I wouldn't be very excited yet. But I think as we hit the festive season, I think we will see some impact on higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We've only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
Welcome back. Well, let's get straight to our favorite segment, D-Street Chatter, where Nimesh will get an insight into dealing room. What is he picking up? Nimesh, take it away. Tell us.
Hi, Nigel. Another flat in the index, but there are a lot of opportunities, or for that matter, a lot of mid-caps and the small-cap stocks have been buzzing and outperforming in the last couple of days, and so is the case today as well. From a flow perspective, I've been saying for the last few days that there is buying into PSU names, and within that, the PSU bank stocks is where there is a lot of FI interest and local interest as well. So that's one space which is well bid. Again, in today's market, overall in general, banks have done well and have relatively outperformed in today's market. Technically, 2500 is a level to watch out on the upside. But the next big trigger seems to be a lot of M&A transaction is what the market is anticipating, and there is a lot of buzz as well in terms of a lot of M&A picking up. So that's something to watch out apart from the earnings. But broadly, it's flat on the Nifty, but there is a lot of outperformance in the broader market names again today.
Okay, all right. Let's get to individual stocks then. What are you picking up, Nimesh?
Well, the first stock on my list, Nigel, today is Edelweiss. That's been buzzing in trade today, up 5-6% last I checked. The volumes also are on the higher side. I understand there could be a large block in Edelweiss very soon, so that's something to track there. So that's the first name. The second stock is Patanjali. It's a little low liquid stock, but big move on that name. It's part of the FNO now. It's up 7%. Essentially, the stock is going up because I understand the selling pressure from one leading domestic AIF is largely over. That AIF was a seller because there is a change of guard at the fund management level, and hence you've seen a bit of churn there. So that's completely sold out, is what I understand in Patanjali. So that's the second stock. The third stock is BPCL. Well, HPCL is buzzing in trade today. From a flow perspective, it's BPCL where there is very strong delivery-based buying from large institutions. In fact, a very large long-only fund seems to be an active buyer in BPCL of the last few days, and today is the case as well. So I expect high delivery volumes there. And the last one is Dynamics Technologies. It's been consolidating in a narrow range of late, but I understand even there could be a large block. A potential clean-out is very likely in Dynamics Technologies very soon.
Thank you very much for that interesting list as always. Counting down to the market close, 15 minutes to go, and the Nifty is absolutely unchanged. 25,200 on the index. Mitesh is back with us for a few BTST calls. Mitesh?
Oh, Patanjali features on my list as well. Buy here with a stop at 1835 for targets of 1880. And Tata Power is the other one. That's also near the day's high. Just a bit off. So Tata Power, I would recommend taking a BTST position with a stop at about 411 for targets of 419.
By the way, IT is going into the next set of results with a fair degree of optimism. The Nifty IT index is up more than about 0.5%. That will come up for you on your screen. Not at the day's high, but virtually there. But look at a Wipro, look at a Tech Mahindra. So right on top, Tech Mahindra should be on your radar because it reports numbers post-market hours. Again, not expected to be a great quarter. In fact, for Tech Mahindra, it would be the second consecutive quarter of a revenue decline. Constant currency revenue is likely to fall by 0.7%. But here, the story in Tech Mahindra is that of turnaround on the top line and even on the margins. And margin recovery is, the low-hanging fruit. So margins have been on an uptick for the last couple of quarters. It would have bottomed out in Q2 of FY24. That's about 7 quarters back when margins went down to 4.7%. It's not showing in the trend chart, but the low was 4.7%. And since then, margins have been steadily recovering. And this quarter, we're anticipating 10.9%. Profits, according to our poll, should be 1,170. So the key is that is Tech Mahindra, on the right path of turnaround? Is that, bearing fruit? Is that progressing well? Because the company wants to hit 15% margins by FY27 end and achieve industry-leading revenue growth. So all signs which help the company achieve that goal will be tracked very closely this time.
Okay, all right. Got that, Rima. Thanks a lot for that. Well, let's welcome Sid Khemka from Motilal Oswal Financial Services who joins us on the show. Sid, how are you feeling about tech? Rima's companies have given us a couple of howlers, but that dip is getting bought into. The bullish argument is they're trading at a discount to some of those, the 5-year, 10-year PAs. You'll get some yield out there. And hopefully, in the coming quarters, things pick up. You want to buy that argument or you want to say, no, too much of uncertainty. Rather wait, buy. When the time is right, that time you'll get in. Your take?
Good afternoon, Nigel. Yeah, I think if you look at the entire IT pack, we have been hearing the uncertainty for last couple of quarters. So I think market is no longer buying into that logic. Some of the companies have definitely upgraded the lower end of their revenue growth guidance. So that also gives confidence that the downside is limited from here on. And as you rightly said, valuations are trading at a discount to to their respective 10-year averages. So within that, you cannot put the same paintbrush across the sector. Definitely, you'll have to pick and choose companies with a much more diversified business model, companies which have invested into the new age businesses, digital, Gen AI, where they are likely to reap those investment benefits in the next couple of quarters. So I think if you look at even Q4, TCS and Wipro painted a weak picture, bearing that some of the others showed some signs of strength in the sense that they were expecting some recovery. I think once the tariff trauma goes away, whenever that happens, IT will be a sector which will see significant buying interest. Yes, near term, number-wise, I think one more quarter of weakness could be there, but from Q2 onwards, I think the earnings growth recovery will happen. Some of the stocks we like, HCL Tech, we believe a very diversified business portfolio growth is there, and I think valuations are comfortable at 22 times on a one-year forward P. Definitely growth improving, valuations should pick up, so that's the top pick within the large caps. Within the mid-cap space, I think earnings growth continues to be pretty strong, both Coforge as well as Persistent. We are forecasting about 22-23% CAGR earnings growth over the next 2 years. Valuations a bit high, but for the growth that they are delivering, I think we are expecting another 20-25% upside in both these stocks. So prefer to be with tier 2 players like Coforge, which is our top pick, followed by Persistent. Their investments in Gen AI, digital, and the next gen business segments are proving to be more defensive in this environment.
Vishal Mega Mart, that's a story that you're like. It listed last year. The issue price was 78. The stock is up 80% from that level. It hit a fresh high today of 140. But you see more upside even from these levels.
Yeah, Rima, I think if you look at Vishal Mega Mart in that value retailing segment has consistently done well. Market has rewarded them amply, and we just initiated coverage today. Definitely, we are looking at a 25% earnings CAGR over the next 2 years. The company is a unique retailer with strong presence in the tier 2 cities, well-diversified exposure to some of the key consumption baskets, and a key differentiating factor that apparel forms about 44%, which are generally a higher margin compared to your staples or your perishable goods. So that gives a strong foothold in overall business. It provides unique moat in terms of competition to both online as well as offline stores, given its presence across India, especially in the tier 2, tier 3 towns. And the balance sheet continues to remain strong, debt-free balance sheet, robust cost control, and hence we believe that even at current valuations, we believe with this kind of growth, there could be further upside to the stock.
Siddharth, do stay on. We just want to quickly talk about PVR. PVR share price is down 1.5% today. And these stocks are in focus because remember the Karnataka government has issued a draft notification whereby they plan to cap ticket prices at 200 rupees per show across the state. Now, we spoke to Karan Taurani, EVP at Elara Capital, on this, and his view is that while the revenue, if it gets implemented, while the revenue and margin impact, EBITDA impact may be 2 to 3%, it could result in derating. And Karnataka does account for about 12% of the overall pan-India revenues. Listen in to his views. We'll come back after the short break.
PVR Inox has got a reasonable amount of exposure in Karnataka as a state, largely because of Bangalore being a metro city. If you look at the screen share, around 12 to 13% of the screens are in the state of Karnataka. And if you look at the overall box office market in terms of revenues, if you put regional and Hindi languages put together, it is anywhere in the range of 10 to 12% of box office revenue coming from there. So I think this news will definitely have a negative impact on the overall ATP for PVR Inox. And in terms of EBITDA, you could see a downgrade of anywhere in the range of 2 to 3%. I think exhibitors will try to lobby hard for this move not to happen. Now, in the past, when it happened, they had gone to the court and appealed. And that time around, this order was rolled back. This was, I think, in 2017.
Welcome back. So markets look like ending flat. We did recover from our early losses, but we gave up those gains towards the close of trade. So the Nifty is ending at that 25,200 mark. So that ITC Hotels, pretty good set of numbers. The stock is up nearly 5% as we speak, 15-16% top line growth, but the bottom line has come higher by 54%, aided by a higher other income. Any thoughts on this entire hotel space and in this Juniper, Samhi, Lemon Tree, Chalet? Which ones would be your, or even an ITC, your preferred bet would be?
Definitely, I think, Rima, if you look at the entire hotels or the tourism space, I think they have been consistently doing well last couple of years. Even Q1, I think, where you have the summer vacation, a lot of domestic travel has happened. So Q2 is where you have a lean period, and then again you start with the festive season, so travel will again boom, and the sector should benefit. Overall, what we have seen is that the supply has been limited, and that has led to improvement in both average occupancy, average room rates. Both have gone up. Costs have remained under control. So the entire sector has definitely benefited. We have two hotels under coverage. One is Indian Hotel, which is the market leader in India. I continue to like it in the premium segment. That's the best play to look at from a Indian hotel sector. In the tier 2, or you can say the mid tier space, we like Lemon Tree, very focused on the business travel as well as tier 2, tier 3 towns where they are consistently expanding and looking at the newer. So religious tourism has been the new trend there. They have added a lot of new properties, and what they have done is that these newer properties are mostly taken on an asset-light lease model or a revenue share model where your growth comes by without putting much of a stress on balance sheet. So I think the overall sector looks good. ITC results are pretty strong, and that should have a positive impact on the other hotel sector stocks as well. So as I said, we like Lemon Tree, which we have a buy rating and a target price of 185. We even like Indian Hotels, where we have a target price of 900.
Okay, what about the cement pack? That's catching everyone's attention today. Deal or no deal, we don't know. But things are looking up, at least in the interim. What's your take out there?
Nigel, if you look at again from a quarterly perspective, cement sector has kind of remained a pretty strong resilience in this environment. Q-on-Q prices have gone up about 5%. Demand remains pretty strong. Raw material prices as well as fuel cost has remained benign. So overall, expect strong volume growth of about 10% for the industry, with the realizations also being strong. We believe EBITDA per ton is likely to improve for the entire space. Yes, monsoon season little lackluster, but once the monsoon season ends, I think most of the players are likely to take even further price hikes that should be profitable. We have also seen that government capex in April, May has been front-loaded and have seen strong growth. That is also supporting the demand. So we remain very positive on the cement space. Ultratech within the large cap space and JK Cement in the mid cap space are our preferred bets within there. Some of the other stocks that we like is Dalmia Bharat. We believe that can be a tactical play given the lower or a comfortable valuation and strong earnings growth over in FY26.
Thank you very much for joining in. It's an absolutely flat close. 0 points on the Nifty. That's the final tick, ending below the 25,200 mark. Metals and defense dragged. Pharma index also ending in the red, a cut of nearly about 0.4%. But on the way up, PSU banks led the rally. IT supportive. Auto realty also gaining some traction. In individual stocks, the top gainer is M&M today, crossed the 50-day moving average after it rallied 2.5%. Wipro, Tech Mahindra, the two IT companies yet to report numbers this week, ended with gains of nearly about 2.5%. Wipro up more than 2. SBI in the back of that fundraise. DLF plans to enter the Mumbai market. Their launch is tomorrow, and stock ending up nearly 1.5%. On the way down, Shriram Finance, Eternal, Sun Pharma, Cipla, Tata Steel were some of the stocks with cuts of more than 1%.
Well, that's right. From the broader markets, Tilaknagar Industries, that was dancing away a little bit high, I think, for the bulls. That stock was up more than 10%. So solid move is what we saw on that one. Coffee Day, the other end of the spectrum, that stock as well was up close to 10%. A couple of influential names appeared in the shareholding pattern, I think. So explains why Coffee Day, in fact, was higher as well. Tilak Nagar Industries, Coffee Day, Vascon, EPC player that's now entered the Mumbai market as a redevelopment, as a real estate player. And they've seen some traction on ground in various parts of the suburb. So Vascon as well in the last few days, well, that's moved very, very well. Big delivery-based buying as well. DLF will be coming to Mumbai and they'll be opening up for booking. So the street did like that as well. So quite a few movers and shakers from the broader markets, though the Nifty ends more or less flattish for today. But on that note, we'll wrap up on this edition of Closing Bell. You don't go anywhere. Markets Forward comes up next.